During my presentations, I have almost always done assessment of a chart using the 20 period moving average. And the question that has been asked repeatedly is why the 20 period moving average? Why not say, for example, the 50 or the 200 or any other natural number, say 5 or 35? So, my view is that it is important for the trader to maintain a certain level of consistency in their approach, and that consistency should have a basis on a strong foundation. As a trader, I am in the market for shorter durations. That is, the longest that I will hold a position is roughly 3 months, and I try to hold the position for that period because that is the expiry that is available as of now for trading. If there are longer period expiries, I might trade those securities provided they have reasonable liquidity as well. The reason for this approach is it saves on the cost of rollover, and it allows me to create a trade factoring in advance the impact of the premium of the future on the calendar spread. That is the impact of the premium because I'm picking up a future several months ahead. And I have typically used the 20 period moving average simply because of the first one is that it is highly popular, and second is that it is very effective. So the rule is very simple, that I am going to just make a note here so that you can refer. Use pivotal highs and lows to determine an uptrend. So let's just focus on the pivotal highs to determine an uptrend. And the strength of an uptrend is determined by the extent of pullback. In other words, where I use price action to determine if the security trend is up or not, I use the extent of the pullback in order to determine how strong that trend is. And the hypothesis that continues in this is that deeper the pullback, the weaker the trend. And the opposite is also true. In other words, imagine you pick up a stock and it just keeps running. From you pick it up at 100, it moves to 110, then 120, then 150. It corrects just about till maybe say 145 and then again resumes its up move and hits 200. Such a stock is very strong trending because the pullbacks are very shallow. Whereas if you buy a stock which is purchased at 100, moves all the way to 125 and then comes back to 105, 108, then such a stock has a deep pullback and therefore the trend is weak. Now, for the process of assessment, it is reasonable to define the stocks in various categories, that is bullish strong, bullish weak, then their bearish counterparts, also to identify if there is a fresh breakout, and the range categories. It is reasonable to group stocks into these categories, whether it's an erratic range or a pattern. But when it comes to trend trading, or when it comes to trading in the direction of the longer time frame, in such a case, the only focus that we should have is whether or not a stock is bullish strong. If there is anything else, we should simply ignore it, even though we have an opinion on it. So once again, like I mentioned, analysis is simply the process of forming an opinion. It is trading that we have to focus on. So now let's just have a look at the Bank Nifty chart, and the reason why I use the 20 period moving average is quite simply explained here. Now my hypothesis is that every time Bank Nifty creates a new life high, how long does it stay below that high once it breaches this red line? Once again, I'll just type this here. Every time Bank Nifty creates a new life high, how long does it take, or does it stay below that high once it hits the red line? So this is basically what I am trying to determine here. So for example, the first blue line that I have formed is this is basically when the index was introduced somewhere in 2005, and we can see that the index created a new high in 2010. That is, it closed the month significantly above the previous high. And one could have various doubts if or not this is an uptrend, downtrend, but a security that generally tends to create a new high. So for example, this is the arrow that I'm marking. At this point, there is no doubt that this is a higher top for that period. And if something is creating a higher top, obviously we are looking at it as an uptrend. Now the question is, once it creates the higher top, the question is, how long does it take to create another higher top after it has hit the red line? So we will see the higher top has created, and at this point it has hit the red line. The time frame selected is the monthly, and we can see that the red line or the 20 period moving average is hit. Now the question here is, how long does it take for Bank Nifty to break this high again? So we can go 1. So this is, so obviously we can simply count this from here. We need a clear closing above that high, and we get this here. So now we can see that it breached this in 2011, August of 2011, and it only decisively took out this high in May 2014. So this is roughly 3 years, or a little less than 3 years, close to 33 months. In other words, if a security is decisively breaking this red line, it took 33 months in order to reclaim that high. And we continue this process forward. So of course we now have a new high, and we will check once again when Bank Nifty takes out, and I think here we get this. So I will repeat this here. We can see that this is an uptrend. I'll just this here is the new high, because this is a higher top, so we know that this is an uptrend. And we are now going to see that after this red line has been breached, how long does it take? So we see that it took it out in January 2016, and the subsequent high, which is around here, happened in March of 2017, which means after the red line was taken, it took Bank Nifty roughly 14 months in order to fully recover and to go ahead and create a new high. We repeat this process again. This is looking like COVID. So once again we have the higher top, and once again we place the arrow here. In other words, at this point there is no ambiguity that this security is in an uptrend. And of course, we saw last time it took 33 months. This time around, after the break, it took just about 14 to 16 months. Now we will see that after COVID, how long did it take? Well, even shorter. So the COVID was obviously in March 2020, and this is a decisive clear new high which happened by February 21, which means just 11 months, even lesser. So we continue this process. We want a clear breach of the 20 period, so we'll just ignore these artificial wicks that hit. There should be a clear breach, and what is the definition of a clear breach, etc., etc. This is a function of the average true range, which I will discuss in some other video at some other time. And we continue with this process. So now what do we get here? At this point in time, we have got that whenever Bank Nifty has broken the red line, it has taken at least a year in order to reclaim that high. That is the first one. Secondly, obviously pullbacks are a part of the game. A pullback in a structural uptrend is a part of the game, but every time it pulls back above the red line, I mean the shallower the pullback. For example, this is a good example here. This is a relatively shallow pullback, because we can see that it has not come very close to the red line. Similarly, we could have another example here and another example here. We can see that they have not come very close to the red line. Typically, whenever there has been a shallow pullback, the new high has happened rather in 1 or 2 quarters. So this is exactly where we are in the market at the moment, that we are seeing a pullback. Of course, we are seeing that Bank Nifty amongst other indexes has performed better. From a high of roughly 54,450, or let's just say 55,000, at this point it has created a low of roughly 47,850. So from 55,000 to roughly 48,000, we are looking at a 7,000 point or a nearly 12.5% correction at the index level, and this is the best performing index at this point, or one of the best performing indexes at this point in time, broader indexes. So we are obviously seeing that this security is trading well above the marked red line, which is simply the 20 period average. And because it is above that, our hypothesis is, as long as it remains above that, Bank Nifty has shown a history of taking out the previous high in a period significantly lesser than a year. So roughly, I would say 2 quarters. So which would mean that from, even if we were just to assume that this is end of Q1, just for convenience, end of Q4. Means so we should expect at Q2 of the next financial year, as per this hypothesis, that Bank Nifty should be ready to completely take out this previous high of 54,450. Now, does it mean that 20 period is the only useful moving average? My response to that is no. You could choose any moving average, but you will have to stick to it. And my assessment has been on different moving averages at different time, and the reason why I choose the number 20 is based on certain conveniences and constraints of my own capital and willingness to trade. That is, if I choose a 5 period moving average, I will obviously get fewer stocks. For example, it means if I look at this, if I apply the same logic but I change the input from 20 to 5, you will note that Bharti Airtel will come across as a very strong bullish stock because it has not yet tested the red line significantly. Or if I look at some stock like this, Bajaj Finance, it is not a great example, perhaps Bajaj Finance. So here Bajaj Finance, we can see, has created a new life high, and one could maintain that as long as it remains above this 5 period average, it will remain bullish strong. Similarly, one could change this and make this anything lesser than 5 is simply too less. One could change this definition to 15. One could change this definition to 35. One could change this definition to 50, and so on. I'm reasonably comfortable with a 20 period moving average. This is an opinion that I have, and therefore one has to see that if I am basically calling out that an index is strong, it means that it is my view that it has not yet pulled back even to its first long term moving average, which in my case is the 20 period moving average. So let's just have a, so once we have done the assessment on the daily, let's just on the monthly, let's just move our assessment to the daily and see what are we seeing based on today's price action. So I'll just eliminate these lines and simply move to daily. Now, in order to see what's happening, we just zoom in closely on the daily price charts, and we are obviously seeing the double bottom here at this point. So I'll just mark a horizontal line here. We are obviously seeing a double bottom at this point. This obviously is a W pattern, and that was in play. And the candlestick that the index is forming today within the range is that of a bullish piercing. So I'll just note this here. This is a bullish piercing. Bullish piercing is very similar to a dark cloud cover in the sense that all we have to see is that the previous move has to be down. So we know that the shorter term and the longer term move on the daily charts is on the downside. We need a gap down open, which is what we get here. And we need a close at the midpoint of the previous day's close, which is exactly what we get here. In the process, this forms a bullish piercing. And of course, this bullish piercing will get confirmed at a reasonable break above the high of today's candlestick. In other words, that all we are looking for is a confirmation on the bullish piercing, at which point this line here, which I have marked, let's just say in red, and I'll mark it dark, at which point this line here obviously becomes a point of support. And how do we trade a bullish confirmation candle once we have a point of support? There are two ways. One of them is you sell the 47,900 put, or the other way is you buy the 47,900 or the 48,000 put. If you're you either go long by buying the 48,000 call, or you go long by selling the 48,000 put. If you are going long on buying the 48,000 call, your hypothesis is that the market is going to trade above 48,000 level till the period of expiry. So we have about 15 days for that. And logically, your stop loss in such a case would be 0 points, because if you are wrong, then the market will not trade above this and come close and take out this low. And if that had to happen, then this assessment that your entry after a confirmation of bullish piercing is incorrect, and logically you should take the loss at which point in time. And if since we are about 2 weeks away or 10 days away from the expiry, if the market is to decisively break that, it is likely to happen towards the end of expiry. So it is reasonable for a trader to assume a nearly zero SL, because it will take about a week or 10 days possibly. Anything can happen, it can happen tomorrow itself, but logically it seems like the market will confirm in the remaining part of the expiry if it has to take out this previous low. So in the meanwhile, one could go long at 48,000 call, keeping in view that we are looking at a bullish piercing now and waiting for a confirmation on it tomorrow. Now, if we look at the confirmation, and let's just assume the confirmation is to happen at roughly where the arrow is marked at, let's say 49,500. I'm just giving a reference number here. At that point in time, the 48,000 call will have a minimum premium of 1500 points, and add some time value to it, and let's just give it a value of say 1600 or 1620. And of course the market would be very excited, so there will have to be some gamma to it also. It will become 1650, 1700 levels. Now the bank nifty lot size is roughly 30, so buying 30 quantity at 1700 with a stop loss of almost zero will risk almost 50,000 rupees on a single trade. Now this is not a trade for everyone unless you are someone who generally risks 50,000 per trade. Then in that case you could go one lot. But if you're a person who generally risks 5 lakh per trade, then you could even consider going 10 lots. But if 50,000 becomes a sizable amount for you, then of course you should simply ignore the option, because that will force you into at the money or slightly OTM option in order to reduce the premium. And if after the confirmation, forget the red line, the bank nifty moves higher but just comes somewhere here, I'm just marking this as a green line, so to speak. Now where this trader would almost break even. So I think a break even point for this trader would be close to this level at 1700. It will be at pretty much the previous high, which means if in the remaining 10 days the price action is to move even close to the previous high, let alone taking out the previous high, this trader who has bought the call option will break even. However, the trader who has bought the 50,000 OTM call will lose money in the process, even though the market has moved up. So it's a decision one has to take, that do you go for in the money options and defend till your stop loss with the objective of taking forward your positions all the way to expiry, or you go a slightly or a deeper out of money option and risk losing your premium even if the price action is favorable in your direction. This is a call that a trader has to take. It is my view that one should be sufficiently funded, but it is a final decision of the trader. So I hope that in this video I have outlined in slight detail that just because a person has a bullish assessment, or just because someone on YouTube like me comes up and says that I'm structurally long or I have a long bias on the market, the final decision to take the trade will be entirely yours. And it is extremely expensive to trade NSCFO segment in the today's market scenario, given the lot sizes that have been changed. So one has to keep this in mind. It's no longer a lot size of 25 for Nifty or 15 for Bank Nifty. They have almost doubled or tripled in just the last few weeks, and this is coming at the back of almost a 10x increase in the margins that are required in if you compare it to the last few years. So therefore, trading as a business is one of those unfortunate businesses where the regulator themselves have an unfavorable view of the trading profession. That in India, the regulators themselves have an unfavorable view of the trading profession, and consequently they keep raising the barriers to entry because they do not want to create a society of more and more traders. This is something that should be known to you, and yes, and if that is known and understood well enough, you may take your positions accordingly. The objective of this video and a series of such video is simply to complement what I'm already teaching at some other places, so that the students see through live examples as they are forming. And and trade planning should not be based on a video. This is my strong opinion, because analysis, like I said, is the process of forming an opinion. Trading is a completely different ball game. It is a process of following rules. I hope that this difference is understood, and at some level we have increased our learning of price action. All the best for the remainder of the trading week.